If someone offered you a 15% discount on your taxes, would you take it? Of course you would. Now, what if I told you that discount was actually a trap that could cost you more money in just a few years? That's exactly what's happening with this new tax plan in Washington, and almost nobody is talking about the catch. Let me show you what's really going on. What's up, everyone? Kevin here, navigating another financial minefield so you don't have to step on it yourself. Today, we're diving into this new GOP tax plan that's promising major cuts for regular working families. Not the corporate elite, not the ultra wealthy, but people like you and me who are trying to raise kids, build some wealth, and create a decent life. But as usual with Washington, there's more to the story than the headlines. Let's break it down. So here's the deal. The House Republicans have put forward a tax plan that would cut federal income taxes by about 15% for households earning between $30,000 and $80,000 a year. Sounds good, right? And if you're in that $15,000 to $30K range, you could see up to a 20% or 21% reduction in 2027. Now, if you're supporting a family on that kind of income, it's not chump change. We're talking about real money that could help with getting that car fixed properly instead of patching it up again. Finally building that emergency fund I'm always talking about, or maybe even starting to invest for your kids' future. The Joint Committee on Taxation, which is supposed to be nonpartisan, ran the numbers. These cuts would put actual cash back in your pocket starting in 2027. But we need to talk about timing, because that's where things get interesting. Here's what they're not plastering all over the news. These tax cuts aren't permanent. If nothing changes, and let's be honest, Congress is allergic to fixing problems before they become emergencies. Those same tax breaks could flip into double-digit increases by 2029 and 2030. You heard that right. The same people who would save 15 to 21% in 2027 could end up paying 10 to 15% more in taxes just 2 years later. So what's going on here? Well, one big piece of this puzzle is something called the Earned Income Tax Credit, or EITC. This is a benefit that helps low-income working families keep more of what they earn. It's one of the few parts of our tax code that actually helps working people who are struggling to make ends meet. The GOP plan wants to reform this credit, claiming it's vulnerable to fraud or misuse. But when you peel back the layers, what they're really doing is reducing future payouts. That means families earning under $30,000, the same ones getting the biggest initial cut, will take the biggest hit when the bill comes due. Now look, I'm not here to tell you which political party to support. That's your business. What I'm here to do is help you understand how these kinds of policies directly impact your family's finances. This tax plan is creating a narrow window of opportunity followed by potential disaster, and it's wrapped in a classic Washington power struggle where both sides are more concerned with scoring points than with your actual financial well-being. Democrats say this plan guts funding for healthcare and environmental initiatives just to give a temporary tax break. Blah, blah, blah. Republicans say they're putting money back in the pockets of hardworking Americans. Blah, blah, blah. Meanwhile, fathers like us are just trying to figure out how to navigate whatever mess they create. So what do you actually do with this information? Here's my advice. First, don't build your long-term financial plan around temporary tax cuts. Treat them as a bonus, not a guarantee. Second, if these cuts do come through, have a plan for that money before it hits your account. The worst thing you could do is adjust your lifestyle upward for a temporary break. Instead, use that window to aggressively pay down high-interest debt. Boost your emergency fund to cover 6 months of expenses. Make strategic investments that can grow regardless of tax policy. Maybe even prepay some expenses for 2029 and 2030. If you can, third, if you're self-employed or run a small business, start running projections now for 2027 to 2030 that assume your taxes will go back up. Build that into your pricing and planning. And lastly, remember that true financial independence means not only being at the mercy of whatever scheme Washington cooks up next. The more self-reliant you become, the less these games affect you. Look, I know tax policy isn't the sexiest topic, but understanding how these changes impact your family's bottom line is critical if you want to build real wealth and security. The people who win this game aren't the ones who get excited about temporary tax cuts. They're the ones who see the whole board and position themselves to prosper no matter what happens. That's what I want for you and your family. Not just a momentary win, but sustainable success that Washington can't take away. If this kind of no BS financial breakdown helps you, hit that subscribe button and that notification bell. I'm here to help men over 35 navigate health, wealth, and family life with clarity and purpose. This tax situation is just one of many challenges you need to overcome together. I'm Kevin, and this is Kevin Navigates. Stay strong out there, and I'll see you in the next one.